Gold barely went to 8,000. That's merely replicating an eightfold move that you had 2 times before in the last 50 years. So if you go to a ratio or a log scale chart of gold monthly, go back 50 years, put it up on your screen, and look at what we're doing now, it looks tepid compared to those bull markets. If we went to 8,000, at least you'd say, oh, I'm doing it again. So we throw out the 8,000 number, not as a target, just saying, if it went there, it's no big deal. It's done it twice before in terms of metrics. The issue is for us, not that, because I don't know where gold's going. 20,000, I don't know. I've got some good friends who are thoughtful economist type, and they think it easily go into that zone.
Gold's explosive rise in 2025 has captured global attention, with prices skyrocketing nearly 40% early in the year, breaking past $3,000 per ounce. The rally has sparked intense discussion among investors, analysts, and central banks as they assess its far-reaching consequences. Market expert Michael Oliver sees this as more than a short-term spike, pointing to persistent inflation, rising global debt, and geopolitical uncertainty as key drivers. Central banks, particularly in emerging economies, continue accumulating gold, reinforcing its role as a critical asset. Oliver believes these factors make higher price levels increasingly likely, with momentum suggesting further gains. Michael Oliver also emphasizes gold's historical tendency to surge during economic turbulence. Since private gold ownership was legalized in the U.S. in 1975, 2 major eightfold price increases have occurred. The first occurred between 1976 and 1980, when gold jumped from about $100 to $850 per ounce as inflation soared and confidence in the U.S. dollar deteriorated. The second unfolded between 2000 and 2011, with prices rising from $260 to $1,920 due to financial crises and aggressive central bank policies. Given today's extreme monetary expansion and fiscal instability, Oliver argues that another substantial increase is possible and consistent with past trends. An eightfold increase from the recent cycle low would align with historical trends, potentially driving gold toward $8,000 per ounce. From a technical standpoint, Oliver notes that gold's current bull market remains relatively steady compared to past cycles. A review of long-term price movements reveals that in the late 1970s and the 2010 and 2011 cycle, gold's most explosive gains occurred within the final 6 to 12 months of the rally. While the current uptrend has been measured, Oliver believes the market has yet to enter its final acceleration phase. Based on historical patterns, he anticipates that gold may soon shift from its steady climb to a more dramatic upward move, signaling the next major leg of the rally. We present the clips of Oliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
News stories that are, whether they're true or not, there's a bigger picture here, and it's the ongoing monetary decay and a crisis now in fiat currencies and debt of governments that is far bigger than any of who's doing what now and when. Gold was going to go up whether China got it behind it or not. And they're now printing money like crazy to help support their market. By the way, their market is not a bubble. The Shanghai Composite is only double the price it was in 2009. We got the 9-fold and 18-fold. So now they're back to printing money, but to hold their market up, and they will go down economically, I'm sure, if we suffer a global downturn. And our metrics say that the Nikkei and the Sensex have now broken as well. So we've got major countries around the world that have signaled the onset of bear markets. And with that will come economic downturns very rapidly. So everybody's probably going down economically. But the question this time is, we do this over the decades, and it seems like boom, bust. Bigger boom, bigger bust. Bigger boom. This time it's going to be, I think, total cleansing, where many institutions, many economic government assumptions, investment assumptions are going asunder, where people will say, geez, it's different this time. I don't just mean how much the stock market drops, but the other realities that will be exposed out there. And a lot of people aren't talking about them. I've put out many times in interviews is that if gold went to 8,000, it's no big deal. Why that number? It's not a projected target or anything of the sort. All I've done is go back to when gold was legalized, 1975. You had a couple of bull markets that were eightfolds. from the mid 1976 low to the 1980 high was $1,003 up to 850. Okay, 3.5 years. Then over a span of a decade, you went from early 2000s up to 2011. It went from $260 to 1,920. Okay, another eightfold move. Now we have fundamental and technical dynamics that are in play that are far bigger than those periods of time. So the excuse that gold had to do that, you got the same excuse now times 10. Okay, but if gold barely went to 8,000, that's merely replicating an eightfold move that you had 2 times before in the last 50 years. So if you go to a ratio or a log scale chart of gold monthly, go back 50 years, put it up on your screen, and look at what we're doing now, it looks tepid compared to those bull markets. If we went to 8,000, at least you'd say, oh, I'm doing it again. So we throw out the 8,000 number, not as a target, just saying, if it went there, it's no big deal. It's done it twice before in terms of metrics. The issue is for us, not that, because I don't know where gold's going. To 20,000, I don't know. I've got some good friends who are thoughtful economist type, and they think it easily go into that zone. The issue is the ratio of silver to gold and the ratio of the gold miners. And we think that is breaking out to the upside, favoring them because the last several years, they've underperformed gold. Actually, since the 2015 low, you mentioned the gold miners a while ago. You measure from the 2015 low to the present, gold miners are actually beating gold, even though they're not above their 2020 price high, and gold is above its 2020 price high by a significant amount. But from the bare low, for instance, in the XAU index in December 2015, low monthly close to its current price, you go back and look at it on your charts, do the math. How much up is XAU? It's actually up more than gold is, measured from its low monthly close at 1,060 back in December 2015 to the present. Yes, they've lagged over the last several years where gold has launched and they've stayed below the 2020 high in the miners. They're about to blow through that. And I think the ratio, the spread relation between the miners and gold is about to go vertical, where they outperform gold in this phase, and silver does the same. And I personally, and we state this in our reports, what positions we have. My emphasis is in silver and the gold and silver miners and in silver miners. Yes, gold is the mama. It will lead the way, but it won't lead percent-wise at this point going forward. We think it will lag the other components.
Recession talk is growing louder on Wall Street, and forecasters are pointing to a handful of warning signs that suggest an economic downturn may be on the horizon. Earlier this month, Goldman Sachs raised its probability of a recession over the next 12 months from 15% to 20%. According to a March survey conducted by Bank of America, 55% of fund managers saw a global recession triggered by a trade war as the top tail risk for the market. Meanwhile, according to the Conference Board's latest consumer confidence survey, the number of consumers who said they expected a recession in the next 12 months spiked to a 9-month high. These indicators highlight growing economic uncertainty and increasing fears that a major downturn could occur. According to Oliver, the scale of the debt crisis makes the current situation even more precarious. Unlike the 2008 financial meltdown, which was primarily driven by bad mortgage debt, today's risks are centered around government debt, both in the US and globally. Nations are grappling with unprecedented levels of borrowing, and as interest rates rise, the cost of servicing that debt becomes unsustainable. This looming debt crisis could lead to widespread economic disruptions, including corporate bankruptcies, mass layoffs, and potential government defaults. As trust in fiat currencies erodes due to excessive money printing and rising deficits, Oliver believes gold will emerge as the primary safe haven asset. Let's get back to the video.
Most bear markets, if you go back 29 to 32, there's 2.5 years, 2000 to 2002, 2 years. 2007 to 9 was like 2.5 years. Most of them get pretty much done in a couple of years. The issue isn't that; it's the dimension of the drop. How much percent drop, and again in the .com era, and Nasdaq went down 82%, where the S&P went down 50%. But the other issue is this: once you enter the gates of hell and you go down, even when you make a low, it takes a decade or more to get back to the high. If you look at NASDAQ 100, for example, made its peak in early 2000. It took until 2016 to even get back to the nominal price high of 2000 So you wasted 16 years just to get, so if you didn't get out in 2000 and you rode it out, it took 16 years to get back to it. And that's nominal because during that 16 years, the decay in the money unit was like 50 to 60% value lost due to the increased supply. S&P took 13 years, making a high in the mid 1500s in 2000. Again, in 2007, made a high in the mid 1500s. It took until 2013 to finally get back through the 2000 and 2007 highs. So that was a wasteland for 13 years in price, up, down, up, down, up, down, if you didn't get out at the right place. And even in nominal terms, you might be back to break even at the old 1500 level in 2013. But in reality, in real terms, you weren't back to break even until probably the 2022 high, in terms of real dollar value of that asset. So that's the issue. It's not just the issue of the drop, the duration, but it's the real world consequences that get exposed by the stock market breaking. Factory closures, collapse in government debt, which is now an issue on the table, not just here, but elsewhere. So suddenly we've got a debt issue that is not a mortgage issue this time. We've got the global government debt issue. And so that could play in a huge way, especially to favor gold.
Economic uncertainty fuels a renewed rush toward gold as investors and central banks seek stability in an increasingly volatile financial landscape. With inflation eroding purchasing power, national debts reaching unprecedented levels, and geopolitical tensions escalating, gold has become a preferred asset for those looking to safeguard their wealth. Central banks have dramatically increased their gold reserves, rising from 1.8% of total demand in 2010 to 21% by 2024. This rapid accumulation drives prices upward, reinforcing gold's role as a hedge against monetary and market instability. While short-term fluctuations are inevitable, the long-term outlook remains strong. The rising global economic policy uncertainty index reflects mounting concerns over shifting monetary policies, trade disputes, and political turbulence. Historical patterns indicate that gold prices tend to follow suit as uncertainty grows, making it a crucial asset in times of crisis. If this trend continues, gold will retain its value and could surge to new historic highs, solidifying its position as one of the most resilient financial assets in an unpredictable global economy. That's it for today. Share your thoughts on Oliver's analysis of gold price prediction in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.